and welcome to our class on chart patterns and their interpretations. Now, I originally did this class about 2018, and you can find it on my YouTube site. It's got close to 3 million views now, and that's pretty good for an educational webinar. But I decided to update it and bring us up to the 2023 and allow us to interrelate with it a little bit more. Now, I would appreciate it greatly if you could subscribe to my YouTube channel. Believe me, we won't email you, we don't bother you, we don't sell anything. Just YouTube will send you out a notification every time I upload a new class. Now, technical analysis refers to the study of the financial markets based on price movement. It uses the assumption that the price of a share or an asset reflects all the information about that asset, including the market sentiment, as well as its perceived value. Charting refers to technical analysis that is performed through careful interpretation of price data from identification of well-known patterns that emerge in price. For example, head and shoulders, channels, triangles, and wedges. Now, chart patterns are well documented in technical analysis literature and are based on the psychological phenomena that occur between the buyers and sellers of financial instruments in liquid markets. Pattern formations do not form a trading system, but rather provide an indication of future trends of an asset as the price breaks key psychological barriers in the form of support and resistance lines. Now, let's take my first side note to everybody. I take the word technical analysis and put it in trash. It's a scary name, it sounds like a scientific term, and it sounds like it's very involved and complicated. Let's simply call it chart analysis. Anything and everything we do on our price charts is technical analysis, or technical analysis requires us to do these things on our charts, and we're simply reading our charts. So by calling it chart analysis, it makes it more comfortable for us, and it just means anything and everything we do with our charts is chart analysis. Whether we're just looking at price, whether we're looking at candlesticks, whether we're looking at indicators or oscillators, whether we're looking at support and resistance lines, whether we're drawing a trend line on our chart, all of it is technical analysis or chart analysis. Now, there are many types of patterns out there. Okay. And they are formed by support and resistance levels converging at each other, or how price reacts with these levels. Now, in the old days, when the prices moved slower, we were hand charting, we would talk about triangles, we'd talk about wedges, we'd talk about pennants, we'd talk about flags. In my world, anytime you have two lines converging at each other to make an apex, and some distance between those lines, which is considered the base, you have a basic triangle formation. Now, we used to call these symmetrical triangles, asymmetrical triangles, declining and inclining triangles. We used to call some of them wedges. Okay. But as you can see here on this chart, a symmetrical triangle, ascending triangle, descending, are all three-sided instruments or three-sided diagrams that the angles of the support and resistance levels are converging at one another to form an apex. Okay. A wedge isn't far much different from that. But the fact is, when we are looking at these in our charts, it gets messy. See, it's very nice and easy to see them here. But in reality, price looks like this. And finding these and drawing them perfectly online with a whole bunch of sets of rules makes it very difficult. Now, the fact is, like if you're using TradingView now will actually put chart patterns on your charts automatically if you click on the right button. But I also don't believe in defining these, just like I don't believe in candlestick patterns. Memorizing all of these candlestick patterns and what they are, what they're called, and what you're supposed to do when you see them is very bad for our trading. It sets us in a mindset that we're not looking at what price is telling us. We are simply trying to remember all the rules and what we're supposed to do at a specific time. Whereas when we see these patterns developing, we should be able to get a feel for them and then understand what price is trying to tell us, not what the rule says we are supposed to be trying to do. Now, a triangle also can be, what's the word, used for calculations. Whether it is a wedge, whether it's a symmetrical, whether it's an ascending or descending triangle, there's always a base. Now, finding where that actual base is, the beginning of the triangle, is important. But the value of the breakout, when price breaks out of that pattern, can be calculated by taking the width of the base. So the distance between the rising trend line and resistance level will give us our projection, because we always need to be able to project, because we need to be able to set a target point. We need to be able to set stop loss points. So our projected movement when price breaks out, because till price breaks out, there's nothing for us to do. And by memorizing what we're supposed to do, we're waiting for price to break this way or that way and do that. Stop wasting your time. Wait for price to break out and then make your analysis based out in the direction it breaks out. Now, when price breaks upward, we should be buying into that asset. When price breaks downward, we should be selling that asset. But this isn't always right. So one of the keys to chart pattern trading is looking at volume. Volume will always confirm what we're trying to see. Okay. So outside of triangles and wedges, we have rectangles and channels. What's a rectangle? I mean, simply price is moving up and down between the support and resistance line. Channel means price is moving up and down in a descending or ascending set of support and resistance lines. But once again, seeing them in the world of live trading is difficult. Okay. Spending our time drawing them on charts is sometimes a waste of time, especially in short-term trading, because the markets are moving so quickly that by the time we realize we have this formation, it's already broken out and moved beyond. So rectangles and triangles are also referred to sometimes as pennants and flags, depending on the slope of the initial trend and the slope of the breakout. And then, as I said, we have wedges. Now, does this wedge look any different, really, than the ascending and descending triangle? Now, granted, in the ascending and descending triangle, we have one line that is horizontal with the other line moving to it. But again, in definition triangles, we have two lines converging to form an apex. Well, in this case, the two lines are traveling at different angles, but they will form, the wedge will eventually form into a triangle. But what is it? And is it a wedge reversal or a wedge continuation? We have no idea until price has told us what it's going to do. So the most common wedges are found as breakouts in the opposite direction of the wedge. That is a bearish breakout in a rising wedge and a bullish breakout in a falling wedge. And lastly, well, not lastly, but one of the most well-known chart patterns, it's only because it really applies very well in the stock market, and it's written about quite often when we read Wall Street Journal, when we read Market Watch, whatever we're watching CNBC, they talk about this head and shoulders pattern. And head and shoulders patterns are very reliable. But the fact is, you don't actually see them till they're almost over with. And in our type of short-term trading, they take too long to develop for us to actually make trades. Now, In this reality here, could you actually see the head and shoulders? It makes a perfectly beautiful head and shoulders, but we have a problem seeing it in the world of trading. Now, head and shoulders, like all patterns, actually have formulas. Now, for head and shoulders, the formula is the neckline, which is the base where all the shoulders are formed and the head or the neckline is formed. Okay. Then we have the headline, which is the highest point. Remember, head and shoulders is the sign of two shoulders, a neck with a head. Okay. And if we were to find the neckline, we could draw the shoulders on. We have the neckline, and then this would be the head. We could measure that, and the distance between the neck and the head would give us the target point for when we break out of the head and shoulders movement. And it works quite accurately. You know, I didn't make these up. These are just what they are. Uh-oh, I can't get my marker to turn off. There we go. And the same holds for true in reverse. But all of the patterns that we talked about have these same basic formulas. Now we have multiple tops and bottoms. These tops and bottoms start with double tops and bottoms. I tell you all to ignore them 100%. In our type of trading, and today with everything trading 4 pips to the right decimal, we get lots of double tops. That means price moved up, hit a point, moved down, moved back up, hit that point again, and fell back down. It happens day in and day out, often more and more and more times. Same thing at double bottom, just reverse. Actually, they look like M's and W's. It's not significant enough to give us any information. But after that, we go to triple tops and triple bottoms. When we get to triple tops and triple bottoms, we can then start relying on whether price is bouncing up and down off that support and resistance level and whether that's going to hold true. And again, there's a simple formula to calculate the move when price breaks that next support level or breaks below that next resistance level. If we take the target is equal to the support level less the height of the movement. So where T is the target level, S is the support level, H is the pattern. And we could simply take the height of this pattern, come down here, and the breakout, our target point, would be there. Because remember, to set trades, we always need a target point. We need a stop loss point, a target point, an entry point, and an exit point. Now, chart patterns are all about breakouts. That's all that it is looking for when price is going to break out of that pattern. Whether it breaks up or down is irrelevant. It makes a decision to us, but we don't want to predict. So an important measure of the quality of the pattern is the trend that precedes it. Okay. The more well-developed the price trend on the charts, when that pattern forms, the more well or the better you can rely on your formulas and the breakout. So when you see price moving in this well-developed trend, this chart pattern is more relevant to us and our trading decision than we see the same highs and lows, but we see prices moving all over the place. Okay. This quality of that trend will help us make a better trading decision. And if we're only looking to make high probability trades, we want to look at the quality of the pattern and the trend as it enters that pattern. Now, the pattern is said to have broken out once it has crossed either the support or the resistance line. If the pattern broke out in the same direction as the preceding trend, it is called a continuation pattern. If the breakout is in the opposite direction, it's called a reversal pattern. So for example, a pattern described as a bullish reversal triangle, well, that's a mouthful, would mean that it's a bullish signal, that it is the breakout went through the resistance line. Because it's a reversal pattern means the preceding trend was in the opposite direction of the breakout. Okay. This is the preceding trend, or this means the preceding trend was bearish. Okay. But as well as we want to look for the quality of the formation, the quality trend, we also want to look at the quality or the strength of the breakout. So here we have a strong breakout. Here we have, most likely, price will touch the outside of a triangle, the outside of a wedge, break through it and go right back into the center. Okay. We need to be able to judge a breakout. Part of that breakout judgment is also volume. So there's many simple ways to trade. We have these formulas where we have this, to set your stop loss, your entry point, your target point for all the patterns out there. And they're actually, you'll find that they're pretty reliable. The only thing you have to be aware of is when you set your entry target or your target point, you must look at the most significant support or resistance level above or below that pattern. Because if it is beyond the target point, you have to readjust your target point to be slightly below that resistance or that support level. So we have continuation patterns, we have reversal patterns. Okay. We have all types of patterns. Some of the best ways to find these patterns and interpret them is with Fibonacci retracement tool. So what exactly are retracements? They are price reversals that produce temporarily within a larger price movement. Retracements are temporary price reversals that take place within a larger trend. The key here is that these price reversals are temporary and do not indicate a change in the larger trend. Fibonacci retracements were designed to forecast the scope of the correction when trends are prevalent. Because, again, you're looking at your charts. You're looking for patterns and interpretation of these patterns within your charts. Okay, chart analysis. And Fibonacci's will help you, as well as support and resistance levels, determine how valid that turning point is in that movement. And whether we're looking at a reversal or a continuation pattern. So reversals are defined as a change in the overall price trend, where continuations are just slight movements. Now, how do we define that? Well, if we look at price, we know the price should be moving in pushes and E's, pushes and E's, pushes and E's. Okay. If we also happen to have a chart pattern, like a triangle, a breakout of that while price is moving could signal that it is a reversal point or a continuation point. We're concerned with the breakout, but how far will that breakout go? Will it reach the trend? Or is it a breakout and going to lose momentum and fall back down? Volume can be the key answer to all of this. So keep in mind, chart patterns is chart analysis. Chart analysis made up of the patterns we see on charts, the trends we see on, not trend lines, but the trends we see on charts, the candlesticks we're looking at our charts, and the support and resistance levels we're looking at on our charts. Because often those support and resistance levels will help us predict whether we have a breakout or not a breakout. And determining whether we have a false signal or a good signal, and where we should put our entry trigger is very important. So, thank you very much. Remember, chart analysis, not technical analysis. Chart patterns, support and resistance, trend lines, the quality of the movement is what it's all about. Using your eyes to look at charts and reading and understanding what that chart is trying to tell you.